So you cannot start planning for volatility once volatility strikes. You have to plan for it in advance, and the way to do that is to not have all your money in one asset class, in this case stocks. So have money in gold, have money in fixed deposits. If you have the ability to understand debt mutual funds, have money in debt mutual funds. And I say this with a big if, because in many cases to newbie investors, debt mutual funds are marketed as something as similar to FDs, which they are not. Because if they promise 7%, they'll give you that 7%, right? Whereas in debt mutual funds, you can suffer huge losses, which people are not really aware of. So you have to plan in advance and be ready to take on that volatility.
Welcome to Wealth Creation Simplified, a special Paisa Paisa series powered by Bajaj Finserv Mutual Fund, where we break down the essentials of smart investing, milestone financial planning, and building long-term wealth. Whether you're just getting started or looking to level up your investment game, this series is designed to make mutual funds simple, actionable, and relevant for young investors like you. With that, let's jump into today's episode. On this episode, we have a special guest with us. Vivek Kaul has spent years breaking down complex economic concepts into insights that actually make sense. As a seasoned economist, best-selling author and columnist, he is known for his sharp analysis of markets, money and financial history, always with the knack of making it engaging and accessible. With books like Easy Money, Bad Money and India's Big Government, he has explored everything from financial crises to government policies, helping readers understand how economies shape our daily lives. If you've ever wondered how global events impact your money or why some financial trends are just hype, Vivek is here to break it all down. Vivek, welcome to our show.
Thanks, Anupam, for having me.
Great to have you here. First question. If the economy were a Netflix series, what would you title the current season and why?
Honest answer, I haven't seen much of Netflix of late. So thinking up of a series would be difficult. But I'll give you a interesting example. I would look at the whole scene as the race movie. If you've seen any of the race movies, there are 3 race movies, and they're directed by this duo called Abbas Barmawala and Mastan Barmawala. And the storyline in those movies tends to be very weird. The good guy can become the bad guy can become the good guy, the bad guy can become the good guy and then become the bad guy again. So the twists just keep coming, and sometimes it's just difficult to keep track of who was the good guy and who became the bad guy and then became the good guy again. So I think the current state of the global economy is like that. And what happens on any given day possibly depends on which side of the bed Mr. Donald Trump gets up from. So if he gets up from the left side, we get something. And if he gets up from the right side, we get something else. So that, I think, is an interesting analogy as to how to look at the global economy currently.
From a 90s Hollywood movie, you think Wild Wild West?
Wild Wild West would be a great example as well. So
Gen Z in India is starting their financial journey amongst rising inflation and fluctuating markets. What is the first thing that these Gen Z people should know about navigating these challenges?
I think the absolute first thing that in my experience Gen Z or anyone starting on their first job should know is to how to look at their salary slip. Okay, I just find it amazing that a lot of people, even in their 30s, do not understand their salary slip. And this is primarily because they have never made an effort to do so. So they have no idea as to, how the company is cutting their taxes or how they can save their taxes or, why they are getting what they are getting at the end of the day. So I think that is the first place to start off for anyone. And I don't see that happening much because people get excited by whatever is happening at a given point of time. So you will see 20-somethings who will give you all the gyan on how to do puts and how to do options, and they have no idea as to what is happening with their salary slips. So it's very, very boring, but that's where I guess we all need to start off.
Yeah. So global events, Vivek, Russia-Ukraine war, US elections, all of these now finally have an impact on global markets and also on Indian markets. Can you break down how something so distant, like sometimes I have difficulty in spotting some countries also on the atlas, how do they impact a young investor here in India?
Okay. See, it also, it depends on how big that international event is. So everything doesn't really impact us. But what happens is the way the media goes about portraying it. Because for media, it's like what bleeds, that leads. Okay. So, and they have space to fill up. So anything that happens in any part of the world gets reported on extensively, and in our heads we sort of end up thinking that might probably impact us. So I'll give you a very simple example, something I went through. So when the dot-com bubble burst, okay, a lot of the companies did not want to recruit, and a lot of companies which had offered jobs, sort of cancelled those appointments. So I had friends who had gone to pretty good engineering colleges and they had jobs from all the, major Indian IT companies. And what happened was, in some cases, or almost in all cases, if I remember correctly, and this is around 2000, 2001, a lot of these appointments got postponed, and sometimes by more than a year and a half. So that was one clear impact of how something that happened in the US ended up impacting us. And, a specific example that I remember is a friend who had a job from a company. He got so fed up of waiting that he went and joined the Indian Navy on short service commission, because he just did not like the idea of being educated and sitting at home unemployed, waiting for that IT company to get back to him. So that, I think, is an example that has always stayed with me. So obviously, everything doesn't impact us, but few things do. And, as an individual, you need to have the thinking capability to figure out how this is going to impact me.
Yeah. So we hear this phrase a lot, right? Time in the market is more important than timing in the market. What is the importance of this phrase, to an investor who's probably starting an SIP of 500 rupees?
I think the importance is, as the cliche goes, if you have to make a good amount of money from the stock market, you have to stay invested for a very, very long period of time. I mean, a lot of, if you are in the habit of looking through reels, like I am, you get this example of how if you had invested in Wipro, if you had invested 5,000 or 10,000 rupees in Wipro in 1976, you would have so many crores now. Or you get all these examples of if you had invested in this mutual fund in 1994. And so in 2025, you would have so much more money. But the question is, at the end of the day, how many people end up investing for that kind of time frame? So, I mean, I'll give you another personal example here. So one of my chartered accountant, he had a client. And so this was some 2008, around 2008, when the markets had reached their then peak. So one day he got a query from a lady who had invested, I think through his father, in 1996 and forgotten about it. Okay. So she came to him and very politely asked, sir, मैंने वो invest किया था, तो अभी पता नहीं कुछ हो सकता है क्या, So she was like, in her head, she had written off that investment. And he then said, हाँ madam, and he took out whatever the details were required, and she was shocked beyond her belief, because in a period of 12 years, the money had really grown, right? So the examples that one hears of those who have invested for the long term and made money are few and far between. I mean, you hear of all these stock market gurus who have grown, who've become very rich. But again, they're very, very, few in number. For a general population, you don't hear such stories because people just keep moving from, one thing to another. It's very difficult to sort of, hold on to what you're doing for a long period of time. But that is what, at the end of the day, helps you make a lot of money.
Vivek, you spoke about the 2008 peak and you've written a lot about economic crisis. So what is the one lesson from that 2008 meltdown? Because there was a meltdown after the peak or even demonetization that's still relevant for first time of young investors today.
Right. See, at the point of the meltdown, I used to work for a business section of a newspaper. And because that was the demand at that point of time, I ended up writing extensively on the financial crisis. So there were a couple of things that I figured out. The first thing was that it was very difficult to understand what was happening because it was so complicated, so complex, and so convoluted. And the second lesson that I took from it was very personal, and it was that one should have enough money in the bank. And by that, I basically mean that one should have enough money in fixed deposits. Now, fixed deposits to many youngsters seem like a very boring product. They give you, as of now, they give you probably 7 to 8%. Inflation is 5 to 6%, so you're barely making any money. But then, sometimes, or rather, at least to me, return of capital or return of investment is more important than return on capital and return of investment.
By that you mean obviously कि पैसा वापस
वापस
आना
आना चाहिए, return on investment, right?
Yeah.
So basically, and you cannot start planning for a crisis when the crisis happens. Okay. So you need to have enough money in the bank so that if something happens, and this, it may not be an economic crisis. It can just be something random. I mean, you might, touch wood, meet with an accident which might put you out of work for some time. Or the company that you're working in may not be in a position to continue paying your salary, or there might be a salary cut. So I remember very correctly in 2008, we had a salary cut, and it was not a very huge salary cut. I think for the seniors it was something around 10 to 15%, but even that 15% salary cut made lives very difficult for a lot of people who were probably assuming in their heads that the good times will continue. Because what had happened between 2005 and 2008 was that our salaries had gone up at different points of time during the year. It was not that, I got an increment at the end of the year.
Annual, yeah.
There were like increments happening every 6 months.
Wow.
Because such was the demand for people in the media that increments were happening at a very quick basis and on a very quick basis. And a lot of people seem to have assumed that this will continue forever. And their expenses are also gone up at that, extensive pace. So I think that was the one lesson that I sort of took from the 2008 financial crisis. And I have been, following it since then. And I'm generally pretty conservative with how I invest.
Yeah. Valuable lesson. Diversification, okay, always a very heavy duty word. But for a first time investor, what does that really mean? Is it as simple as saying choose 4 or 5 different mutual funds?
No, not really. I mean, first you need to choose 4 or 5 different mutual funds. So I think in case of, so I'll address this question in 2 parts. One, I'll talk about mutual funds, and then I'll talk about diversification as a whole. So, when it comes to investing in mutual funds, what typically tends to happen, and again, this is from my experience of talking to people about their mutual fund investments, is that a lot of people end up investing in more than 5, 6, 7 schemes. And there are people, in fact, a few months back, I had gone through a portfolio of a very close school friend of mine, and he had investments in 30 mutual fund schemes, and his wife had investments in 17. So obviously there was a lot of many schemes which were common, but on the whole you could say that the family had invested in more than 30-35 equity mutual fund schemes. So that is not diversification, that is over diversification. I mean, I don't know if there is a word like that.
Yeah.
But I mean, the point being that at the end of the day, mutual funds invest in stocks. Equity mutual funds invest in stocks. And if you're like investing in 5 to 7 schemes, you pretty much have almost every stock that you should be investing in, right? So that over diversification is best avoided. But what typically tends to happen is that when people invest randomly, or they invest on when through their friends calling them, or they invest through an agent and not through a proper financial planner, they end up buying every new scheme or many new schemes which are launched, and which is how they end up with as many schemes as a lot of people end up with. So that has to be avoided. So as long as you have 5 to 7 mutual fund schemes, I think that is fine. Beyond that, one needs to diversify into other investments as well. I mean, as I said, I am a great believer in investing in fixed deposits. However boring they are, however cliched they are, you need to have some investments in gold. And beyond that, if you can afford it, you need to have some investments in, or rather, if you own the house that you live in, so you automatically have an allocation to real estate.
Yeah.
So I think a sort of a breakdown between all these asset classes is good diversification. Now, whether it may not be the best possible thing happening, but it is better than not doing anything, which a lot of people, if you look at what has been happening since October, a lot of people are, finding that out now, right? People bet heavily on certain stocks and certain sectors which were, around which a very strong narrative was set. And a lot of these stocks are now down 25, 30, 40%.
Yeah.
So people who had 100% allocation to such investments are now 30, 35, 40% down. So diversification, the funny thing about diversification is that you don't realize its importance until you need to realize its importance, right? So that is my big answer on diversification.
So you mentioned about how in 2005 to 2008 incomes were going up, but expenses were also going up, which means inflation was there. And inflation has been high in India also for a while. So you have inflation that's eating away at your savings, and you've got interest rates also, which I think up till a certain point were rising. Now they might have plateaued. That's a different thing. But what specific mutual fund strategies can young and first-time investors consider to take care of these challenges, inflation and interest rates?
So, to go slightly off the question, so I come from Ranchi, and the most famous person from Ranchi is Mahendra Singh Dhoni. Now, the thing that I love really about Dhoni, other than the fact that he's given all of us so much enjoyment and so much pleasure, is his view on controlling the controllables. There is a lot of uncertainty out there, and you can't possibly control for everything. So you try and control for what you can control for. So I don't think it is possible to have a specific mutual fund strategy to address inflation. So the best way to address this situation is to keep regularly investing, keep doing your SIPs, have a proper diversification strategy in place, and think about the fact as to what kind of investor you really are. Like, I can talk about myself. Given the fact that I do not have a regular job, right? So my income can sort of go up, come down. So I really don't like to take a lot of risk. So that is my, in any investing that I do, that is the basic thought in my head. And that being the case, sometimes I'm even okay with the idea of a part of my portfolio not giving me as much returns as the inflation is. Okay? Because as I said, I want my money to come back to me. So I think this is how you address the whole issue, wherein you think about, what you are comfortable with and what will not give you sleepless nights at the end of the day. And if you are if you're comfortable with taking on more risk than I am, then bet a lot of money on mutual funds. If you're not, then have some money in equity mutual funds, have some money in fixed deposits, and so on. So
you've given me a lead into my next question, right? Because you spoke about two things. One is how in this recent rally, or at least what was there last year, there were certain narrative-led sectors, stocks, which went up, and then they obviously saw a very sharp correction. And people who had invested or gone with the narrative are now looking at a fairly large loss, depending on at what time they were invested. We saw what happens after 2008, markets fall, etc., etc. So there's anxiety in this. And a lot of first-time investors kind of feel that anxiety when markets are volatile, and markets are always volatile, right? How do you think that these first-time, the young investors can build the mental resilience to stay calm and focused, and basically stick to your plan?
Okay. See, so I'll go back to 2008 again, because I think that is the reference point stuck in my head. So, you would remember this very well. After the market peaked in January 2008, we had many days when the market fell by a huge amount. And every such day, my bosses, my editors at the newspaper I used to work for, wanted a story on what should the investor do now. Okay? Now, what could the investor do at that point of time? Nothing really. If you have invested all your money in stocks and that the value of those stocks has fallen. It has fallen. You really cannot do much. So the point being that you cannot start planning for volatility when volatility strikes. You have to plan for volatility before volatility strikes. And again, at the risk of sounding very, very cliched, the way to do that is to not bet all your money on one asset class. And this is not just true about stocks. I mean, this is true about real estate as well. A lot of people, great believers of investing in real estate, when the real estate market is on its up, as it was between 2002 and 2012, bet a lot of money on buying projects under construction, or even where the idea was just on paper. Right. And then the builders disappeared, or they couldn't complete on time, or the builders were basically rotating money and basically, using that money to buy land and build their own asset book. So you cannot start planning for volatility once volatility strikes. You have to plan for it in advance, and the way to do that is to not have all your money in one asset class, in this case stocks. So have money in gold, have money in fixed deposits. If you have the ability to understand debt mutual funds, have money in debt mutual funds. And I say this with a big if, because in many cases to newbie investors, debt mutual funds are marketed as something as similar to FDs, which they are not, because FDs will give you whatever. I mean, if they promise 7%, they'll give you that 7%, right? Whereas in debt mutual funds, you can suffer huge losses, which people are not really aware of. So you have to plan in advance and be ready to take on that volatility. So if you look at people who have not bet all their money on stocks in the last few years, they have been in a comfortable position in the last few months. Now, their being in a comfortable position also comes at a cost, right? Diversification also has a cost. So for someone like me who did not bet a lot of money on the current rally, I have lost out because I did not get the gains that a lot of others did. But at the same time, what has happened since October, or in case of public sector stocks since July, August, I have been sleeping well at night. So it's all essentially, how you balance, and whether you want to sort of sleep well at night, or you want that adrenaline, going over and over again when the stocks are doing well. So this is how I look at it.
So, given that you also speak a lot about popular culture on your newsletters and all, if I were to ask you the same question in a more spiritual or a philosophical way, right? Because people like you and me have suffered losses in our
course,
whatever. So so for someone who's doing this for the very first time and sees ki between last Saturday and this Saturday, my demat balance value is 50% less. What takes you through those tough times? Like, it could be, I don't know, religion, spirituality, going just for a walk somewhere. And
I mean, the way I have seen it, people just sort of egg themselves on, sab theek ho jayega. But, you need to understand that a stock that falls 50% needs 100% gain to just recover that 50%, right? So something that is 100, if it becomes 50, needs to rise by 100%. And only then you recover that. So I think that has happened. So what you have to do is essentially write that off and move on in life and do the right things, invest in the right stocks. And if I say this with a lot of experience. I started investing in stocks only in around 2020. And before that, I was always a mutual fund investor, and the reason for that was very straightforward. One was because, I was in the media and I was sort of close to people who had all this kind, who invest in stocks. So to sort of not be accused of doing anything illegal at any point of time, I stayed away from investing in stocks. But more than that, I think I did not have the time and the mental energy to sit and figure out, which are the right stocks to invest in. And typically, I also would like to say this, that, just because I understand the economy does not mean, or just because I understand the stock market at an aggregate level, does not mean that I understand which are the good investing opportunities going around. These are two very different skill sets.
Yeah.
And vice versa, if you look at a lot of people who make the money out of the stock market, like fund managers and brokers and so on and so forth. Now they are good at identifying, or at least they need to be good at identifying certain themes in which money can be invested, or stocks and so on and so forth. But that does not mean that they have a great understanding of the overall economy. So we, as people who watch this space, they tend to confuse the two, right? So there are fund managers who are now giving gyan on the economy. There are economists who are giving gyan on stocks. ऐसा नहीं होता है.
But there's one behavioral thing that often happens. At least it used to happen. I remember that people just turn away from the markets.
Which is, I have
this
seen.
This is not for me.
I have seen that.
Like, I can't accept that
I'll give you an example. Before the show started, we were talking about scamsters, right?
Yeah.
So we spoke about Harshad Mehta, Ketan Parekh. Now, between Harshad Mehta and Ketan Parekh, there was another stock market scam, which people have forgotten about.
Well, lots of them in the 90s.
So this was 93, 94, 95, when companies, hundreds, if not thousands of companies came up with their IPOs, collected the money and disappeared. So one day they were there and the next day they were not there, right? And people, have lost a lot of money in that scam, and then stayed away from the market till around 2007, 2008, when the next crisis hit.
That's also cost.
So, that's the funny thing, and I was looking at some data recently for a piece, and that data really struck me. So I started in the media in 2005, okay? And one of the first things I was asked by my bosses to do is to go to all these new mutual funds which were being launched. There were press conferences, and mutual fund launches, when I started, new mutual fund launches were referred to as an IPO. Okay,
and in those days, before it became NFO.
Then it became NFO, new fund offer. Okay, so I looked at some data, and that data really shook me up. In 2007, 2008, there were around 55 NFOs, equity mutual fund NFOs, 55, which raised close to 43 to 44,000 crore rupees. Okay,
43 to 44,000
crore.
I was with 1 0 less on that.
No.
Okay.
2007, 2008, 55 NFOs, so which practically means one NFO a week.
Yeah.
Every week, some mutual fund launched a new, on an average. Okay. So this happened. Between 2008, April 2008 and May 2017, which is 9 years and 2 months, less than 44,000 crores were raised by NFOs. So I'm talking about what was raised in 1 year was higher than what was raised over next 9 years and 2 months.
Crazy.
Then there were 4 NFOs in June 2017, and it is when, at that point of time, that the 2007-8 number was beaten. So, and between April 2007 and June 2017, I think close to 250, 260 NFOs happened. So what does that tell you? What that tells you is that people who burnt their fingers in 2007, 2008 stayed away from the stock market for close to a decade.
Yeah.
So that is, what happens is people don't think about that. We just get carried in by at what is happening at a given moment.
And that defeats the whole time in the market thing, because if you stayed away then. So Vivek, what's happened is that in the last, I would say, almost 8 years, maybe even 10 years, technology has had to play a very big role in investing. Apps and platforms have actually made investing easier for the younger generation to invest in the market. So-called democratization of finance has happened. That's the good news. Is there any hidden risks there that you would want, that makes you cautious?
I think there are two parts to the answer. So, as I said, I started investing in stocks sometime in 2020. And this was largely because there were a lot of these low-cost brokerages which hit the market and made it very easy to open a demat account. So before that, I had tried a couple of times to open demat accounts with legacy stockbrokers, and the amount of time it took and the paperwork, etc., just put me off. But when I opened my first demat account, it took me around, and I did it almost at 12 in the night, and it took me around half an hour to 40 minutes to go through their entire process, which was online. Okay? And I opened it up, and it was active in another 2 to 3 days, and then I could buy and sell stocks. So I think that democratization bit is one reason why, if you look at the fact that close to 80% of the demat accounts have been opened only from 2020 on. Okay,
Wow.
so that's the great part, because you can easily invest in stocks. Now, vis-a-vis compared to something in the 1990s when my father used to invest in stocks from Ranchi, where it used to be very, very complicated. You had to go through a sub-broker and then buy, and then certificate. There used to be stock certificates, and they would take months to come to you, and sometimes your name would be wrong, then you have to send it back, and so on and so forth. So that is one part of it. I think on the flip side, the danger is, and I can see that happening with me. So earlier what would happen was, when I invested only in mutual funds, my CA would send me a monthly statement, and I would look at it, I would not look at it, and it would continue. Now with a phone, with the app on my phone, I can look at it through the day. I can get up and look at Aaj market kahan gaya. Then at 12 o'clock I can look again. At 3:30 I can look again. So there is this temptation to keep buying and selling, because the whole thing is so
Easy.
close to you and so easy. And sometimes it's scary also. Even before you sort of say yes, the thing is sold off.
Transaction is executed. Yeah.
Transaction is executed.
No OTP also.
No OTP, huh? So that bit I find very scary. And I think if you look at on another side of it, if you look at the fact that payments can also now be made so easily digitally, so I have a theory on this in the sense that in the last few years, the household financial savings have fallen in India. And one reason for that, I think, is because it's become so easy to pay digitally. So when we spend money, we don't feel the same pain that we used to when we spend money using cash.
Yeah.
Now, this is pretty well documented that, the moment you start spending money using a card or any other digital medium, the spendings tend to
Increase.
go up.
Yeah.
So I think that is the flip side to it. And it works both ways. So it's like a knife, right? Yeah. So you need to know how to use it.
Yeah.
So
Okay. Winding down the episode now, last couple of questions. What's a common myth about economic uncertainty? Myth about economic uncertainty that you'd love to debunk for our audience?
So say economic uncertainty, the myth is that it will come when it will come. And you cannot really forecast it with great confidence. So the myth really is that there are a lot of people going around who keep forecasting economic uncertainty, and on the flip side, there are a lot of people going around who keep forecasting all is well, right? So the truth always is somewhere in between. At most times.
Yeah.
At most times, so that disclaimer is important. So I think more than economic uncertainty, I think I should repeat this point, is the fact that how do we prepare for economic uncertainty? And that cannot happen once economic uncertainty has struck. So you have to be prepared for economic uncertainty at all points of time. So to give you a very simple example, so let's say you're employed somewhere and you're paying a monthly home loan EMI, okay? And so at any point of time, you need to have enough money in the bank so that, at least 6 to 12 months of EMI can be easily paid without you having a job. So let's say if you lose your job, you should be able to continue paying that EMI. Yeah. Unless you're like emotionally detached from the house that you live in and you're ready to sell it, which almost, no one is. So you need to plan for economic uncertainty.
Yeah. Now the journalist in you might be a little bit uncomfortable in this last question, but I'm guessing the person who tweets should be able to
answer this.
Okay. If you had to summarize your advice to our audience, to young investors, first-time investors, in one sentence, what would it be? Something they can remember and act on like tomorrow.
I think that one sentence would be that it is almost impossible to get rich quickly. I mean, I think there are only three ways through which you can get rich quickly. First is you steal money, which belongs to someone else. Second is if you inherit some money from someone you were not expecting to. And third is if you're lucky enough that a venture capitalist invests in your business idea. So these are the three ways through which you can get rich very, very quickly. In order to become rich through investing, it takes a lot of time. Now, I'll give you a very funny example. So when the Bitcoin surge was on, not the current one, but the previous one, 2021. So I wrote some pieces against Bitcoin, and a lot of people did not like it. And so I was so basically, when the Bitcoin guys do not like what you have written, they tweet and tell you HFSP, have fun, stay poor. Okay. But my point is, people other than, the Bitcoin whales, who are the big players out there, the smaller guys who made money out of Bitcoin, how much money did they really make, right?
Yeah.
You probably invested 10,000 and that became, let's say, even at its upper end, became 50,000 rupees, right? So with that 40,000 rupees, what exactly are you planning to do? So you cannot become, rich quickly through investing unless you sort of take a huge amount of risk, and that risk comes off.
Which is more luck than skill.
Because usually, if you look at a lot of the stock market gurus also in India or all across the world, they have ridden the waves. It's not, no one really became a stock market billionaire in a bear market, right? So you've ridden that wave. Now, obviously, hats off to you that you had the vision and the mental capability to ride that wave. So I think that is the most important lesson, and especially in an era where finfluencers are, mis-selling so much, wherein, like yesterday someone sent me a reel where the influencer was essentially saying that if you earn 35% year per return, so in 10 years your money will go from this to this. And
35%?
35%.
Not bad, eh?
I'm like, if you have an idea for earning 35% per year return, why are you making reels? Chupchap se invest karo and make all the money that you possibly can. So
probably someone's just discovered Microsoft Excel's.
So that's the whole thing. If getting rich was just dragging a cell on the Excel sheet, then we'll all be millionaires and billionaires, and in dollar terms. So.
Yeah. And in dollar terms. And that is a wrap on this episode of Wealth Creation Simplified. Thank you so much, Vivek, for your time and insights. If you are starting your investment journey and are wondering where to start, subscribe to the Paisa Vaisa YouTube channel and anywhere you listen to podcasts from.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.